Beyond the numbers, the unexpected secrets to success for hedge fund managers. The journey to becoming a hedge fund manager involves mastering a complex web of financial strategies, market analyses, and investment decisions. Yet, for many successful fund managers, the most pivotal decision they make isn't tied to any of those areas. Strangely enough, the key to their success often lies beyond the realm of finance altogether, rooted in personal choices that extend into their private lives. The case against the intelligent investor. For years, aspiring investors have been told that Benjamin Graham's The Intelligent Investor is required reading. It's the cornerstone of value investing and a book that has earned praise from Warren Buffett himself. However, there's a surprising twist. Some of the least successful hedge fund managers seem to be the ones who quote it the most. Like Sherlock Holmes solving one case after another, The Intelligent Investor does provide a blueprint for financial logic. However, many who swear by it resemble more of a bumbling Inspector Clouseau than a sharp market sleuth. This doesn't mean that the book lacks value. It's a classic for a reason. But managers who rely too heavily on it, without thinking critically or independently, may miss the broader context required for real success. It's not enough to cling to established wisdom. Hedge fund managers need to develop their own instincts and strategies. The overlooked importance of trading psychology. When discussing success in the world of hedge funds, people often focus on strategy. It's easy to assume that the best strategy wins, but what's often overlooked is the importance of a manager's psychological approach to trading. Managing emotions, particularly in volatile markets, is just as crucial as the technical aspects of trading. There's a particular book on trading psychology that many successful managers rank among the top 3 for serious traders. The book delves deep into the psychological toll of risk and loss, a far cry from the simplistic motivational books that promise to teach traders how to win in markets where most people lose. Instead, it emphasizes something much more vital: learning to lose. Mastering the art of losing gracefully, without allowing it to derail future decisions, is a skill that separates the great managers from the mediocre ones. Interestingly, one of the book's most insightful points is its use of the Kubler-Ross grief model to explain how traders cope with financial losses. Managers often face denial, anger, bargaining, depression, and acceptance as they navigate the markets. Understanding this emotional journey is key to long-term success. Why hedge fund managers should read a marriage book. It may seem out of place to suggest that a marriage book could be more valuable to a hedge fund manager than financial theory, but the reality is quite different. The state of a manager's personal life, especially their marriage, can have a profound impact on their professional life. A healthy, supportive relationship can directly influence a person's ability to succeed in high-pressure environments like the hedge fund world. Statistics show that unhappy marriages increase the risk of heart disease by 35%, while those in happy marriages tend to accumulate 33% more wealth than their less fortunate counterparts. Why? Because financial decisions are not made in a vacuum. Emotional security at home gives hedge fund managers the freedom to take calculated risks at work. On the other hand, personal turmoil often leads to risk-averse behavior, which can limit growth and performance. Divorce. The hidden wealth killer. Divorce is the single most expensive financial decision a hedge fund manager can make. On average, divorced individuals are 20% poorer than their married peers, and for fund managers, the consequences can be even more severe. In fact, divorce rates in the hedge fund industry are often an indicator of market downturns. A surge in divorces between 2006 and 2009, as reported by the Financial Times, mirrored the financial crisis during that period. The costs of divorce extend far beyond legal fees and settlements. Managers going through a divorce often experience a decline in professional performance. The stress of personal conflict bleeds into their work life, making it difficult to maintain the sharp mental focus required in such a demanding industry. Divorce saps their emotional energy and impairs their decision-making abilities, turning even the most seasoned managers into risky, emotional traders. The effects of personal stress on professional success. A hedge fund manager in an unhappy relationship often finds their personal stress spilling over into their professional life. Imagine leaving home for work after an argument with a critical spouse. The manager's mind is preoccupied, and their emotional state is fragile before the trading day has even begun. This mental distraction can lead to impulsive decision-making and poor risk management on the trading floor. The situation becomes even more dire during periods of professional loss. Managers may face a losing streak, with clients pulling out and mounting pressure from superiors. After an exhausting day of battling the market, returning home to a spouse who offers criticism instead of support can feel like a knockout punch when they're already down. Chronic stress like this, both at home and at work, leads to elevated cortisol levels, which, over time, damage the prefrontal cortex, the area of the brain responsible for decision-making and long-term planning. When a manager's brain is overloaded with stress, they can no longer think critically or strategically, reducing their effectiveness in one of the world's most competitive industries. Investing in relationships to boost professional performance. The takeaway here is clear. For hedge fund managers to succeed, they must invest as much in their personal relationships as they do in their professional ones. A supportive, healthy marriage isn't just a bonus, it's a critical factor in a manager's long-term financial success. If a manager is trapped in a failing relationship, they will face personal and professional hurdles that will limit their ability to thrive. Ultimately, a happy, stable marriage is the best investment a hedge fund manager can make. Nurturing a supportive personal life allows for greater focus, clearer decision-making, and the emotional resilience needed to navigate the highs and lows of the financial world. For aspiring hedge fund managers, the advice couldn't be clearer. Start investing in your relationships now because the returns will be invaluable.